Okay, thanks everyone for coming to class today. Today is October the 5th. We're going to be going over day 7 of the syllabus. We will be covering price action and some of risk management.
Down, rejects back up, priced in. Closing a little higher than we opened.
Okay. All right. So we need to make sure that everyone understands bearish reversal signals. Did everyone get this part here and understand that this here is a bullish candle and it opened at the bottom? Price rose all the way up here. That's why this wick is so long. But price did not sustain. It actually reversed and came back down and closed here. Does everyone understand that?
Yes.
Yes.
Because if you understand how this works, it'll help you understand the candles. So that's on, this is all bearish reversal signals, but this here is a bullish candle because it's green. So on the red bearish candle, which is a bearish reversal signal, price open here, and this is the opening price. Okay, price reversed when it came all the way up here, reversed and came back down and closed at the bottom. Because remember last week we learned that the green candles close on the top and the red candles close at the bottom. So what you need to know here is that price came all the way up and reversed back down, basically, on both of these candles. And these are bearish reversal signals.
Hey, quick question. I'm sorry to interrupt. This is literally my first class, and this is literally my first time joining any of these trainings. Is this more intermediate or?
This is actually the second week of the course, so you're probably not going to understand anything that we're talking about today because everything we started this on last Monday. However, all the videos that we went over are inside of your back office, and there's also a 2-week syllabus inside of Operation Promised Land Facebook group, and the 2-week syllabus has all the videos that you would need to watch in order to get the basics, basically.
Okay, so are you starting any classes like over or?
Yes, we start over every 2 weeks. So Monday, this next Monday, we'll be starting a brand new 2-week course. It will be at 7 p.m. on the same link with the same password.
Okay.
7 p.m. Eastern Standard Time. So you can get a head start if you like by grabbing the syllabus and go ahead and you know, get started looking at them, and that way you'll have a head start on watching the videos, and then just either get with us in class on Monday, or we also have all the videos that we've recorded from last week up to this point are also inside of Operation Promised Land.
I appreciate you so much. Thank you, guys.
No problem. Thank you for joining us. You don't have to leave. Trust me, just sitting here today, you know, watching us and just hearing this repetitively is going to help you.
Right. Thanks for all listening.
Okay.
Thank you.
No problem.
Okay.
Okay, so does everybody understand how these two candles open and close and know that they are bearish? They're bearish because price came up, did not sustain.
Yes.
Okay. All right, so here, bullish reversal signals. Here, this is where price opened and came all the way down to here, and price reversed, and price closed at the top. This is considered a bullish reversal signal. The bullish reversal signals, the body is at the top. The bearish reversal signals, the body is on the bottom and the wick is at the top. Same thing here. This candle opened here at the top. Price came all the way down. Price reversed, went back up, closed here. Price closed above where it went down to. It went back up. So it's a bullish reversal signal. So if you see this candle, a candle like this at the bottom of a downtrend, this is a bullish reversal signal. It's telling you that price is going to go back up because it could not sustain when it came all the way down to here. So price is not going to continue to go down. That makes sense.
Yes.
Yes.
Okay. So let's look at some of these. Okay, so the bearish and the bullish candle reversal candles that we just looked at are called exhaustion candles. Okay, so I want to look at this so you guys can see some examples of them.
So right here, right from the get-go, we have a solid exhaustion candle right here. Price came up, got rejected back down by the time this candle closed. Price has since been falling to the downside. Okay. Right here, we've got a smaller one. Right here, we got a little exhaustion here. Price fell to the downside after printing one of those. Right here, we have one that's going to the upside. Another exhaustion candle. Right there. Price rejects up. Price continues to the upside afterwards. Over here, we've got another exhaustion candlestick. Price exhausted up. Price continued to go up.
Now remember how we were saying last week that depends on which time chart you're on. That's how long it takes for each one of those candles to print out. So I want to tell you this just so you can understand how this happened. I'm not 100% sure. It looks like he might be on a 15-minute chart.
He is.
It could be the 15-minute chart. I think it is the 15-minute chart. So each one of these candles, it takes 15 minutes to print, right? So after this green candle right here where my arrow is, after this green candle right here printed, this candle started to print and it had 15 minutes before it was done, and this candle here started printing. So during that 15 minutes, price came all the way down here. But before the end of the 15 minutes, price went back up here, and this is where it closed. Everybody got that?
Yes. Yes.
So that's how those wicks are created. Remember when we talked about drawing your structure lines last week, and I was telling you how important it was that when you draw those boxes to determine if you break structure or not, how you wanted to include those wicks. This is why. That's where, because even though the body of that candle is not up there, price, that's how price went, which means that it's a possibility that price can go back there. That makes sense.
Oh God, now the thing that went off.
Huh?
Yes, it does.
Okay.
Yes, it makes sense.
All right. So everybody feel like they understand what the bearish reversal signals are. The exhaustion candle.
Yes.
Let's watch a little bit. Let's just watch a little bit more.
Now here, this one has a little bit more force to it because the candle body is quite a bit bigger. But overall, once this printed, price made it to the downside. All right, there's examples of this stuff everywhere. We have a green exhaustion candle to the upside. We have another one here. And we even have one right here. You can see price printed these and continue to the upside. Price printed this one and then fell afterwards. It's very easy stuff. You guys will catch on pretty quick. Right here, a good way to remember this too, by the way, is imagine that the exhaustion candle, like this one right here,
Oh
you take
man.
this exhaustion right here and you compare it to this arrow. We have a wick, right?
Put my phone
And then
on
where
it.
the arrow
Not
branches
this way.
out, that's like the candle's body. So if you just picture that the body here is the head of the arrow, that's the direction that you're headed after printing that exhaustion. You can see that once this printed, we then headed to the downside. Also, once this red one printed here, we headed to the upside. Okay? And there's examples all over the place, guys. Here's another one. Right here, printed that, price went down from there. And then before making a move back to the upside, printed yet another one. Okay, so these candlesticks are everywhere. Moving on. We've got more exhaustions. Here's a lot of wicks in here. It's back and forth. But price does print an exhaustion right there. What does price do? Price goes to the upside. This is the general idea behind these candlestick formations. But you have to listen to what price is telling you all the way down. I mean, price, just to give you guys an idea, price was all the way down here, and this candlestick was one big mean red candle up until it got rejected back up. And then following the rejection, price goes on up. Moving on. This one, there's too much wick on this side. For me, I wouldn't label this an exhaustion. You got exhaustion on both sides. Moving on.
Did everyone catch hold to that? When you have a candle like that, where it's got exhaustion on both sides, it's not going to be considered a reversal signal. Okay, because remember what a reversal signal is. You're gonna have a lot more wick on one end because price went to a certain price and did not sustain and came back down. You will not have it on both ends of the candle. Okay.
Wick on both sides. Over here, we have two exhaustions right in a row, in case you missed the first one. Okay, so we got this one and this one. Both these candlesticks printed. Price came down, could not withstand the force of the buyers here. Closed back up here, and then.
Does everyone understand that these two exhaustion candles, that price pushed back up and then price pushed up to the upside?
Yes.
Okay, because I know I was talking with someone earlier and that's what they didn't get. They didn't understand how these bearish candles here could represent going to the upside. It's because the price came down, did not sustain, and went up. That's letting you know that price is going to go up. It can't continue to go down because it didn't. We did this on 2 candles in a row.
Following, price began to rise. Very easy stuff, guys. Over here, we've got more exhaustions. Both of these are bearish candlestick formations, but one of them did close higher than it opened, and then vice versa. So even though one is technically a bullish candle and the other one is a bearish, they're both bearish signals.
Everyone get that? You got 2 signals right here side by side, one being a bullish and one being a bearish. Okay, you see how the bearish one closed above and it's pushing down, and what did price do? It went down. This is a bearish one. This was a bearish one too. It's just a bullish candle.
Okay, we've got more exhaustions here towards the bottom. What price do? Price went up. Moving on, moving on.
Everyone write this down in their notes. Bearish reversal signal will have the wick at the top. The bullish reversal signal will have the wick at the bottom. Let's say it one more time. The bearish reversal signals will have the wick at the top. The bullish reversal signals will have the wicks at the bottom.
You've got 2 exhaustions here, right here and right here, and doji within here. Actually got 3 exhaustions. Boom, there's another one. And then price does indeed flow up.
Everybody see this candle right here? Someone had asked last week what a doji candle was. Remember, we were saying this indecisiveness in the market. They don't know, like the bears and the bulls are fighting. The buyers and sellers are going back and forth. No one's overpowered the other one yet. So whenever you get what looks like a plus sign, an addition sign, that's what a doji is. It could have some body on it, just a little bit. It would still be considered a doji, would mean indecisiveness in the market. So does everyone feel like they know the difference between the bearish reversal and the bullish reversal signals, and know what the exhaustion candles are and how to read them in the market?
I think so. I did have one quick question. I missed part of what you were saying, or what he said when the wick is on both sides.
When the
What was the
wick is
meaning
on
of
both
that?
when the wick is on both sides, it's not really considered a reversal signal, because
Okay.
remember, a reversal signal means that price came all the way down or went all the way up to a certain point and could not sustain and came back down, and you're going to have a
Okay.
body on one end of that candle.
Okay.
Now, you might have, you shouldn't have a wick, but you're not going to have 2 large wicks coming out on both sides, like right here. You see this?
Okay. Mhm. Okay.
It's going to
Yeah.
be
No.
more of like this, like how you can see that price came up to a certain point and then went back down. You'll just be able to see wick on one side. You shouldn't see wick on the other side.
Okay. Okay. Got it. Making sure I didn't miss something.
Okay. No, that's good.
So the like where the 2 arrows are pointing, where you get a little bit of wick in the bearish signal, that's okay, correct?
Right here. Like
not,
right
not
here.
that one, the other one, to your right.
Here.
Yes. So even though you got a little bit of wick coming at the bottom, that's okay.
Yes, that's okay. Just a little bit coming out the bottom, that's okay. And okay, so like if we had just this first one, this green one, no, but that's why this one printed behind it. And so this would have been like the confirmation that it was going to go down.
Oh, I see what you're saying. Okay.
You guys remember the in the first days when Andrea took us through the support and resistance, and you know, the CEOs were teaching us about the bank orders and all of the big financial institutions, right, running their orders. And so
Remember that.
you can see this exhaustion happening. You know, if you keep that in mind about support and resistance, you can actually literally see it happening once you start learning price action, market structure, candles. So thank you very much, Miss Andrea. You are, I need to see the hair whip. I need to see it. You're doing it up.
So yeah, that's exactly right. That what he just said, you know, when we had went over that and they were talking about, I think they had like 100 million orders and they broke them down and put in like 25 million at a time. And at the end of that, when they had placed that last order and price came back down, it was exhaustion candle printed at the bottom of support. It was at the bottom of, let me see, I can't remember. I want to say a support, then price came down, it broke, retested, and continued to the downside in that particular example. Everybody remember that?
Yep, and that just brought it all together and make a lot more sense now.
Okay, yeah, so that's basically what that was. That was an example of, at the end of it, after showing how they place the orders once price get to a certain point, because they want to buy it when it's at its lowest point, right? And so yeah, that was exhaustion candles printed at the end once they had got all the orders put in. Okay, so I feel like if no one has any questions on this price action video 1, we are done. Everyone understands bearish reversal signals, bullish reversal signals, and these exhaustion candles, what they represent, how to read them in the market. When you see them, you should know.
Yeah.
All right.
Yes.
Good stuff.
Yes.
All right, so we're gonna go ahead and go over price action video number 2, which is talking about railroads. We're gonna go over that, and then we're gonna
Down
go
here,
over stop loss,
we've got
and then that we're gonna wrap it up for tonight, and we'll meet back here tomorrow.
more examples. There's plenty of it.
Get to the other video. You guys still see my screen?
Yes.
Right here is a bearish reverse.
All right, so in this video, they were talking about railroads. Okay, now everyone knows that the symbol of a railroad will be 2 lines parallel to each other. Okay, now here in the Forex market, when you have 2 candles that are the same width, the same height, they're considered bearish reversal. It'll be a reversal if it's a railroad, and I'm gonna tell you how to distinguish if it's a bearish or if it's a bullish. Okay, so if the first candle is green and it's bullish, whatever the last candle is going to be that reversal signal. So in this example, you know, price came, it rose all the way up, closed here, price opened here, came all the way down. It didn't continue to go up. It opened here because, you know, each candle is going to open. The next one is going to open wherever the first one closed, right? So price came all the way up here when it was going bullish and it closed here. Just act like this got a little small wick on it, just so, because some people, it's hard for them to look at this and understand what I'm saying, not looking at it as a candle. Was helping someone earlier and that made it click for them. Okay, so price open here. So when the next candle open, it opens where that one closed, which was here. But price didn't continue to go up. It came back down. Candle printed red. Same exact size. Bearish reversal signal. Price is going down. Does that make sense?
Yes.
Yes.
That's the bearish reversal railroad. Whatever the last candle, whatever the color of the last candle, if it's the same size, at least the same size or bigger, because if it's bigger, it's considered engulfing, which means that it overpowered the bulls, and we're going down. Okay.
Okay. Got it.
All right, here.
Took the question right out my mouth.
Really?
Yep, I was just about to say, so if the green was the last candle, and there it is.
There it is right here. Yes. Okay, so same thing here is just the opposite. A bullish reversal signal means that you were probably in a downtrend, printing red candles. This candle opened, price came all the way down here, and the candle closed. The next candle is going to open where this candle closed at. So this opens here. It's a green bullish, so it's a reversal because price came all the way up to the same size as this candle, came up to the same price as to where this candle opened at. If it had let's say this candle was bigger and it came up here, it would still be a bullish reversal signal because now it's an engulfing candle. Engulfing means bigger than, larger than.
Are most of them the same size? I mean, like even across like they're showing here, or in the actual market, is it very different?
They're for the most part going to be the same size. It could be, it's going to be the same size or bigger. It could be like almost the same size, like right at it. Never think that a half a candle printed, like let's say that this price came up to here. That's not a bullish reversal. It has to be at least the same size to be 100%. Well, you can't even be 100% because you never know what the markets are going to do. But this is a reversal signal when you know to be looking out for the reversal when you see the candle print that's equivalent to the one prior to it or greater.
Is it safe to say that the next candle is going to continue up? Is that a safe bet?
Yes, because this is saying that this is a bullish reversal. So if this was a bullish reversal, that means that price was coming down. and then we printed this green, and now we're going up. So it will be safe to say that the next candle is going to open here, because this is where this closed. It's going to open here, and it's going to go up.
Okay.
And that's what's going to start your uptrend.
Gotcha.
Would that green candle also be indication to get in the trade on a buy?
Yes, but now you can't get in on this candle. You know why? Who can tell me why you can't get in? Why you can't get in on this candle? While it's printing?
Next candle, even though these.
Who knows the answer to that question?
Well,
Not you, Aaron.
I know
Anybody but Aaron.
I know a answer. I don't know if it's the right answer.
Okay, what's your answer? Let's see.
Well, there's two reasons. Well, I don't even know what the structure of the market is. I don't know if it's near a support or resistance. I don't even know if the next candle's gonna be.
Right. Okay. That's good.
That.
That's part of the answer. One more person.
Because there's no retest.
No, you will have the answer. The correct answer is because you have to wait to the close of this green candle to even determine if it's a bullish reversal. We won't know if it's a bullish reversal until it's completely done printing.
Oh, so you mean we gotta have patience?
You got to wait. Yes.
Okay.
Okay.
Does that make sense? Because let's say this candle had only printed like halfway, and you jump in, it can turn red, and price can start going down. You might think it's a reversal, a bullish reversal, because it has overpowered this candle by 75%. But we on a 15-minute time frame, and we still got 5 minutes left. And you jump in because, oh, you think it's a bullish reversal. Well, in them 5 minutes, price start to go down. This candle turn red. It's going down. We end up with a long wick way up here.
Okay, I see what you're saying.
Mm-hmm.
So it can look like that while it's printing within that 15 minutes.
It could,
but
yeah.
once
it could be, let's say
finishes
we
and
was on a
closes,
right. We could be on a 15-minute time frame, and it could shoot up here at like 12 minutes. But within them last 3 minutes, it could come back down and only be half of this candle.
and the wick would be the rest of that.
Yes.
If it did go back down, okay, I see what you're saying.
And Marie said,
Well,
can you
here, well,
repeat that
actually
one more
here,
time?
let's say price did come all the way up to here. Price came all the way up to here on it, and then it came back down. Yes, you would have some wick up there indicating that price shot up there.
Okay.
But if you had got in in a buy thinking that it was going to be the bullish reversal when it was going up, you see how it wouldn't have worked for you by the time that candle closed. Because if that happened 9 times out of 10, the next candle is going to print. Remember, it got to print where this candle closed at. So if it closed at like halfway, it's going to start printing here. And more than likely, because price didn't sustain up here, it's going to go to the downside.
Okay.
So you wait till the next one start printing and then get in?
You wait to the close of this one. If you see this and you wait for the close of this, and then I normally wait to see what the next candle starts to print. And if I see it printing a green candle, I'm in there.
Okay.
Got you. That makes sense.
Okay. So if it starts printing red, does that mean that is that the retest? Would that be an indication of a retest?
Well, it wouldn't be
it wouldn't be a green.
It wouldn't be a retest, but it could just be some bearish pressure in the market.
Okay. Because it's a reversal, is really going up. But it
right.
Okay. Okay. All right. Okay.
You got it?
I got that one.
Okay.
Also remember, guys, okay, the railroads can go for any amount of length of candles, especially on lower time frames. So, you know, once you learn how to scalp, you'll love it because you're just basically going back and forth. But as a beginner, it's kind of like a jump rope, and they got like 3 ropes, and you're trying to get in. You're like, what's happening? Yeah. Okay, so be patient, and just how Andrea's telling you guys, wait for these candles to form and wait for your confirmations. That's gonna make you a better trader.
Yes. So in
These
this
candles
particular
closed
video, that's
in the
basically everything that he explained was these bullish and reversal signals. So what I'm going to do is we're just going to look at a couple of examples of the different railroad signals, okay? And then we're going to move on to risk management.
that today. So right here, these 2 candlesticks right here, that's a railroad. So we have a bullish railroad, right? Because price comes down, and then price comes back up, mimicking the other side, essentially, and price continues to the upside. So there's one example of a railroad in the charts. Another one, really solid one, right here. Okay, these 2 candlesticks, solid railroad there. Got a solid green candle and then a solid red candle. Our bears took over, railroad back down, price falls to the downside. Very simple, guys, very simple. Let's see if we can find any more. All right.
So you guys, when you start trading, you're going to take everything that we've learned and kind of put it all together to be able to do this. So if you were going to be looking to get into the market, into a trade, we know that you got to determine the support and resistance. First of all, you got to determine what trend the market is in. Remember, we learned that. I think it might have been like Tuesday or Wednesday last week. Trend identification by drawing your trend line. Determine what trend the market is in. Then determine where your support and resistance levels are. Okay? After you determine where your support and resistance levels are, you're going to look for your market structure. You know, draw your arrows, use your trend line, and draw your lines to determine where the market structure is. And that's how you're going to be able to place your trades. What they're teaching you now about these candle reversals, after you do everything that I just mentioned, that's when you're going to start looking for these candlestick patterns. Okay, they're not teaching you this candlestick pattern for you to just open up a chart and say, okay, here goes some railroads, let me jump in this trade. Need to make sure that everybody understand that.
Got it.
This is not a strategy. This is part of a technique used to go along with trading. And I know it seems like we went over a lot, but if you just, when you look at the charts, you do it in that order, basically in the order in which we've learned, and you'll be able to take the trades from there. Does that make sense to everybody?
Yes.
Ma'am.
Yes. Okay. All right. Let's look at a little bit more of this.
Right here. Right here. Now this green candle does have a little bit of wick on the end of each side, but that's okay. Price formed the bearish railroad and fell to the downside. Again, up here, before price took this huge fall, the these.
Now, the reason why I want everybody to understand the reason why he said that this right here was okay. The reason why this railroad is considered to be okay and considered a bearish reversal, railroad reversal, is because even though it's got the wicks on both sides, price did not sustain. The bearish candle is about the same size as the actual body. Does that make
Yep.
Yes, it does.
There's a lot of bearish too behind it.
that's the only reason why this is considered a bearish reversal. And as you can see, what happened after this candle printed. You see what happened? Price continued to the downside.
Also, Andrea, do you see the candles before that railroad? You
Yes.
literally like just kind of explained those being bearish signals too, right?
Yes. Here, right here before the railroad, you see how you see this little exhaustion candle here?
Mm-hmm.
And so once you got this, and then you got the next candle printed, and the body was the same size as, it's a little bit smaller, but it's just about, it's the same size. So that's why it's very important for you guys to go through that candlestick Bible, because what would have made someone 100% sure of this railroad is not just the fact that the bearish body was about the same size, but it would have been the candles prior to it also. Because look here, you see this candle right here, price came all the way up to here, but it didn't sustain. So it was getting weak. It came all the way back down. Then here. So all of that together would have let me know that, hey, this market is about to go bearish. And then let's not forget that you also know how to do market structure too. So you would have already had your market structure drawn out, right? And you would have knew too that price was up here. And then once it came down here and it broke your low, remember? Now we in the what? We in the bearish market anyway. Even if you didn't catch the candles, even if y'all didn't tell the story from the candles, you could have got in on the trade just from what you know about market structure. Did that make sense? Did that just click for anybody on this call?
It did for me.
Yes.
Yes, it did.
Absolutely.
Okay. So don't make this hard. Just use everything that you're going to learn during this 2-week course, because everything that you need to know as a trader is in that back office, but everything that you need to know as a beginner is on this 2-week syllabus. You still need to go through that stuff in the back office, but if you just get this 2 weeks worth of stuff down, you will be able to go and demo and make a little change.
I got a question for you.
Yes.
Will you be starting this over every 2 weeks? Is it a rotating thing you're gonna be doing, or?
Yes. We'll be starting over live every 2 weeks, but we do record because we know, some people work later, don't get off till late. So I do record them. They can be found inside the Operation Promised Land.
I'm trying to get up to speed on all this. I appreciate it. I got another question real quick that I just realized something. I think so whenever you see a candle, do you mean the price actually came up? I mean a wick. Price actually came up to the wick. It just pushed back down or pushed back up, either way.
It means that it didn't sustain. It didn't stay there. That's how high it went up during that time frame, depending on whatever time frame you're on. Right now we're on a 15-minute. let's just say this was the 1 hour time frame, right? We're gonna act like this the 1 hour. And so that means that each one of these candles took an hour to print.
Okay.
And so that means within the hour, price came all the way down to here. But it didn't stay down here by the time that hour closed. By the time that hour closed, it had then came back up. That's where the wick come from.
I'm gonna give you an apple for the teacher. Thank you for that.
Uh-huh.
Well, you can walk it to her. She live across the street.
Here or up there? Down there?
No, she's in Indy.
Get out of here. Apple's on its way.
Yes.
Hello?
Okay, so does everyone understand that? Did that just click for everybody that even if you didn't catch on to the candles, if you just did what we discussed the other day with market structure, you would have seen where structure would have been broken and we were in a bearish market, which we was in a bearish market up here. But you would have knew to keep moving it, and you would have knew that you could have stayed in sales because your market structure hadn't been broken. Right?
Yes.
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 Right.
Yes, that's right.
Okay, so let's see. All right, so I think everyone understands bullish and bearish railroads. Anybody got any question on bullish and bearish railroads? Nope, moving right along.
2 candlesticks, right?
Okay, so now we're going to talk about this risk management video for anybody taking notes. Risk management video number 1.
Shorter video, very simple video. By this point, I assume that many of you guys have already gotten this concept down, but it doesn't hurt to go back through it. So basically what we're going to do is we're going to take just some example setups that we might have, and we're going to look at the risk to reward and identify if we should even take that trade to begin with. So here, small example, we have a counter trend line breach, or a trend line breach, if you will. Let's say we want to sell this breakout, or we're trying to figure out if we should sell the breakout candle. Well, the first question that you have to ask yourself is, where does your stop loss have to go? Your stop loss has to go above here, right? Above these highs, somewhere up here, right? And ideally, you'd probably be getting out somewhere in between the high and where your stop loss is at, somewhere in that zone if price were to breach, right? In most cases, obviously in this case, price is going to come up and just breach your stop loss right there. But that's the risk on this trade, okay? 162 pips. That means that for this trade to make sense, you need to at least have 162 pips in the other direction.
Okay, now I'm going to stop this. All right, so first off, does everyone understand what a stop loss is?
Yes.
A stop loss is placed to protect your account in case the market finds a lot of volatility and liquidity, and it goes in the opposite direction. So for each trade that you take, here they were going in for a sale, right? They got in the sale right here at this price level right here, right? So they said they were going to take it down to here. This would have been their TP, take profit level. Now, whenever you place a trade, you want to set a stop loss because the stop loss is going to protect you in case it goes in the opposite direction. In this case, they were in a sale. If it were to turn around, which it did, it's going to take you out of the trade when it hits whatever level you set. You want to do this because it's going to help you manage your account. Because let's just say you set this trade and you set a TP which is a take profit level, meaning that you think it's going to sell down to here, and you did not put a stop loss, and let's just say when price came up here, it kept going. Well, it never hit TP, right? So guess what? It's continuously eating up your account. Continuously eating up your account. You're bleeding in red. It's negative. It's going down. It's going to blow your account until you come back and see it and you hit the button and exit the trade. But if you set the stop loss when you enter the trade, you set a take profit and a stop loss. If it does go the other way, at least you know, hey, I risk this amount. You're going to know exactly how much money, depending on how many pips it is, and we'll learn how to do that later this week. You're going to know exactly how much money you're going to lose on this trade if it goes the other way. Okay? I want to bring this to your attention. Not saying that this is a proper way to trade, but I just want to make sure that everyone peeps this. He's on the 4 hour. Do you see how this man just drew a what? Trend line on this here? And once he got the trend line break, they're checking out the trade. Not saying that this is a good trade. What he's showing you is how to determine if the trade is worth taking or not. Because we want to figure out what the risk to reward is. It doesn't make sense for someone to take a trade where they're trying to catch 20 pips going this way, but the stop loss is 100 pips. So you want to risk losing, you know, that much money to make this little bit of money. You don't, that's not a trade that you want to take. So we're going to watch a little bit of this, and I'm going to show you, which we went over already one time last week, but we'll go over it again, how to set these short and long positions and where to set the stop losses and determine if your risk to reward is good enough to take the trade or not. Okay, remember that when you do set this, you always want to set your stop loss above the most recent high, right? If it's a sell, and below the most recent low if you're in a buy. Do I need to say?
No, got it.
Yeah, one more time, please.
Okay, when you're in a sell, you're going to set your stop loss above the most recent high. When you're in a sell, you're going to set your stop loss above the most recent high. When you're in a buy, you're going to set your stop loss below the most recent low. When you're in a buy, you're going to set your stop loss below the most recent low.
Okay, I got it.
Okay? Does that make sense to everybody, what I just said? Can you picture that? If you're buying, you want to be able to say, hey, I only want to lose $5 on this trade.
Yes.
If you're selling and price decides to go up, you want to say, hey, I only want to lose $5 if price turn around on me and go this way. I don't want to blow my account. Let me set my stop loss.
Yeah.
Now, there is a thing called stop hunt, where the markets will turn around and reverse on you, and the institutional markets is just placing orders to come in to take all of us retail traders out. It will go right above the most recent high and then turn right around and go down. So you want to make sure that you setting your stop loss to where those wicks won't take you out. Okay?
So if there's anything in the way of that, you should probably reconsider taking the trade. Now, the first thing that I noticed looking at this is that if you look over here within this trend line, you can see there's a clear support right here. Clear support, okay? And now let's see if this is something that we need to be worried about. Look at this, guys. There's a whole zone. Looks kind of like that. Yeah. Look at this SNR in here, guys. Pretty significant SNR. Every interaction the price has had with it, it's been very well respected, right? So if price gets to this SNR, we would expect that it would at least give some kind of bullish momentum, some kind of bounce. And guys, look, that's going to be where price reverses right there, okay? So if you are looking to take this trade and you identify that this has to be your first take profit zone, you should consider not taking the trade. Now, what can we do in the first take profit zone?
Okay. You guys see this. You see right here, when you set this over on Trading View, remember, this is what you're putting on Trading View. I showed you how to use this, how to basically, this is like placing a trade without placing a trade. You set the trade on Trading View right here by determining if you're going to go long position, if you're buying, short position, if you're selling. Set your stop loss and your take profit, and then let this sit and see if price goes the way that you wanted it to. That's trading without placing a trade in your demo account. That's trading right off the Trading View screen, just like kind of drawing the area so you can see. Now, when you do that, you see here the target level. It tells you how many pips it is that you're targeting, and it also tells you how many pips it is that you're targeting on the stop loss. Here in the middle, it tells you what the risk to reward ratio is. This here isn't even a 1-to-1 risk to reward ratio. A 1-to-1 risk to reward ratio would mean that you were going for 50 pips and you were risking 50 pips to gain those 50 pips. That gives you a 1-to-1 reward ratio. Now, whenever you make your take profit, let's say this, we're in the sale and we're going to take this take profit down here to these lower lows, you're going to see the risk to reward ratio change. That's going to make for this a better trade. It's not a great trade when what you're risking to lose is close to the amount that you're trying to gain. The best trades are the ones where you're trying to gain more and only risking a little. It makes your risk to reward ratio greater. Does that make sense?
Sure does. I don't want you to miss out on your commitment. It's been an hour, but you
right.
can keep on going.
I know. I'm about to wrap up. I just text them. They know. 1 second.
This trade, and you identify that this has to be your first take profit zone, you should consider not taking the trade. Now, what can we do in this case, right? So we can't sell this candle, but maybe we can make it a succession for ourselves, and we can say, okay, but if price will give me a retracement up into these highs and give me an opportunity that has better risk to reward, I will take this trade. Right, so maybe when price does its first retracement, let me zoom in here so you guys see what I'm talking about. See how this candle gave us a retest of our trend line? Maybe we re-identify an entry here and we check the risk to reward. Does the risk to reward make sense? No, it doesn't. So we're not going to take that. And then we wait and price comes up into our zone. That's another potential sell opportunity. Does the risk to reward make sense here? What's the answer? The answer is yes. Guys, this is the trade that you take. This is the trade that you should have taken in this situation. And guys, notice how all those other entries, they would have worked, yes, but but you would have had a lot higher risk. You would have had a lot lower reward. Guys, if you sold the breakout candle right here, you walked away with 70 pips. If you waited for the correct opportunity, you walked away with over twice that, 160.
Does everybody see how you got more pips and why this was a better trade? Because here, when they just waited for it to break that trend line and they got in, price was down here. So when you set up for the trade and do the stop loss and take it above the most recent high, you're further away from the top of the stop loss. So when you set your take profit, you ending up with more pips in stop loss than you are in take profit. So it's not a good risk to reward. But here, this was the better trade because it came all the way up to support level. And remember, you want to sell when price is high. Price came up, price is higher now. However, it didn't break that level, so the stop loss is still in the same area. But the stop loss is not far from our entry because we would have been entering this trade right here where my arrow is, where the head of the point tip of my arrow is. We would have been entering the trade there, okay, because it broke and wait till it come up. This the retest, bam, we in the trade. And that way stop loss is only got to be set above the most recent high, which is here. And so it gives you greater pips to catch down to this support level, which means that it's a better risk to reward. Does that make sense?
Yes.
That makes sense to everybody.
Yes, it does.
Yes, it does.
I'm
eating my
hamburger.
It does. You
All
can
right.
visually even see it right there.
Right.
when
And
you have
another
more
thing I
time.
wanted everyone to make sure they knew too was whenever you're trading, you need to, yes, you set your stop loss and you'll take profit when you place the trade. But these markets, we can't predict what they're going to do. What we're teaching you to do is trap price and then react to it. However, after you react to it and it's playing out, you need to take what you've learned. I'll use market structure, for example. And let's say you're in for a buy and you see that market structure was broken and that this is clearly, gone into bearish territory. You need to be prepared to manually exit your trade. You can manually exit a trade at any given time. If you're the type of person that has a job and you can't watch the charts all the time and you're going to be trading, you probably want to choose higher time frames because that will fit your schedule and you will be able to watch it and close it manually if you need to. If you can't, if you don't have time to commit to sitting there to, most scalpers do the lower time frames and just like get in, for the short moves and get out. The higher time frames, it takes a little longer for you to hit TP because you're on the higher time frames. And remember, each one of those candles, it takes that amount of time to print it out. But you're able to see if you can't sit there and watch it all the time, it's best for you to take them on a higher time frame. But remember how we went over, you would look for the setup on a higher time frame, then you would drop down to the lower time frames to check and make sure, like if, let's say you looked on the 4 hour, you're going to drop down to the 1 hour because you want to make sure that if you're in a sale, if you see a sale set up for the 4 hour, you want to make sure that the 1 hour is what? Bearish, right? We don't want to get in when if the 1 hour is bullish because that means that the 4 hour can't be bullish territory yet. Right? Then we just learned that, I think, Friday. And so we check it there. Once we see that we got the bullish territory, then that's when we drop down to the lower time frame and you're looking for your candle to enter.
Right.
Okay, so does everyone understand stop loss?
Yes.
Yes.
All right. Okay, so we're going to go ahead and end right here, you guys. I apologize for tonight, but I do have an event that I have to get to. And so what we're going to do, tonight's homework is going to be day 10. Okay? It's not even an hour's worth of videos. So if you didn't get a chance to finish up the videos from the weekend, this gives you the opportunity to do so, because we're going to finish discussing those tomorrow. Tomorrow in 10 of everything in there, most important things that you need to know out of all 3 days. Okay?
Okay.
All right. So does anyone have any questions about anything before we end?
Ma'am.
Thank you. Thank you.
All right. Well, I will
Thank
see
you.
you guys here tomorrow. Same link, same time, same password. Do day 10 for homework. And you guys have a great night.
Thank
Good
you.
night.
You too. Have a
You
great
too.
night.
Thank you. Good night, everybody.
Good night.
Woo woo.
Right? So very simple example.